This is ACC Amit Kumar and we'll discuss IFRS 1 first time adoption of IFRS. We had already discussed that this is a standard which is used by a company or a country only once. Because once they have used this standard, this is no more relevant, because then the applicability of standards determines the accounting policies, how they're going to account for in future. So this is kind of a facility given to the entities or countries to converge to IFRS standards. So they converge it to IFRS standards using this standard as the first level of conversion. So this has a lot of facilities to facilitate conversion in an easy manner. If you remember IAS 8 accounting policies, there was concept of retrospective application. And if we change an accounting policy, we are required to apply the retrospective effect to all the periods to which it is practicably possible to do so. Now, when we are converting the entire balance sheet, we are changing all the accounting policies, and it is not practically possible for us to go back even if we wish to apply retrospective application. So to facilitate conversion, the main requirement at this point of time was how to deal with this approach of retrospective application. So IFRS 1 came up with the solution that why don't we categorize all the line items in terms of mandatory exemptions, that in these areas you do not need to apply retrospective application, and optional exemptions, that these are the areas where you have an option not to apply retrospective application. You can use the existing figures, or there's a way out suggested wherein you can move forward, and in future if you change any accounting policy, you will have to apply the retrospective application till this date. So there is a facility provided through this standard. So this is one of the easiest standard, I would say, because this gives us a facility of conversion. So once we identified that what we are going to do, in some of the cases property, plant and equipment can be taken as deemed cost. So whatever is written in the previous GAAP, the same figure we simply need to carry forward in the new GAAP and term it as Ind AS or IFRS. So it makes our life easier. So look at the scope, opening IFRS statement of financial position. I have discussed all this in the first introduction session as well, but here I'll be focusing on now the optional and mandatory exemptions. So objective of this IFRS is to ensure that entities' first IFRS financial statements and its interim financial reports for part of the period covered by those financial statements contain high quality information that is transparent and comparable, provides a suitable starting point for accounting in accordance with IFRS. This helps facilitation of moving on to IFRS. Can be generated at a cost that does not exceed the benefits, because if we calculate the cost of applying retrospective application, it will not be possible for any company to apply retrospective effect since incorporation, or as far as it is practicable to do so, they will all be against application of IFRS. So this standard is the starting point which motivates them to move to IFRS. The entity shall apply IFRS in the first IFRS financial statements and each interim financial statements prepared in first IFRS reporting period when an entity adopts IFRS for the first time, or when they issue an explicit and unreserved statement of compliance with IFRS. In India, we'll issue an explicit and unreserved statement of compliance with Ind AS. We'll not issue a statement of compliance with IFRS because we are not adopting IFRS in India. We are converging to IFRS. So our statement will be that we are in compliance with Ind AS, not IFRS. Entity shall prepare and present an opening IFRS statement of financial position at the time of transition to IFRS. Hope you remember these opening balance sheet now. If we are preparing our financial statements, if it is applicable to financial year 2016-17 in India, what will be the opening balance sheet? First time adoption of IFRS. If it is applicable to financial year 2016 and 2017, if the first IFRS financial statement is to be presented on 31st March 2017, what will be the opening balance sheet? Comparative will be of 31st March 2016, and beginning of the earliest period presented, that is 1st April 2015, is the opening balance sheet. We'll take the balance sheet of 31st March 2015, which is on previous GAAP. We'll apply the guidelines given in IFRS 1 first time adoption of IFRS, and we'll have IFRS compliant financial statements of 1st April 2015, and we'll be successful in presenting IFRS compliant financial statements if we follow the approach given by IFRS 1 on this day. Converting this 31st March balance sheet into 1st April balance sheet by applying the principles of IFRS 1 first time adoption of IFRS. Hope this is clear to everyone. This is the starting point. So entity shall use the same accounting policies in its opening IFRS statement of financial position and for all the periods presented in the first IFRS financial statements, that is of 31st March 17. Those accounting policies shall comply with each IFRS effective at the end of its first reporting period. Even if there are new accounting standards which are effective now, they also need to be incorporated. IFRS 1 also permits early application of new IFRS. Now, the date for financial instruments was 1st January 2018. The date for revenue from contracts with customers was 1st January 2018. Date for IFRS 16 leases is 1st January 2019. But if we are preparing our financial statements of 31st March 17, we could opt for early application of these standards. That is permitted by IFRS. An entity shall in its opening IFRS statement of financial position recognize all assets and liabilities whose recognition is required by IFRS. So the assets and liabilities which were not recognized earlier in the previous gap, we need to recognize them now. If we recognize them now, if we increase the assets, there will be a corresponding increase in the retained earnings. If we increase the liabilities, there will be a corresponding decrease in the retained earnings. So all the adjustments of increase or decrease, plus or minus on the balance sheet will be adjusted against retained earnings. Any plus you do, any minus you do will be impacting the retained earnings. Not recognized items as assets or liabilities, if IFRS does not permit, there are some assets or liabilities which are recorded according to the previous gap, we need to de-recognize them. Reclassify items. Some of the items were classified under the head equity. Now they come under the category of liabilities under the new gap. They were classified as current. Now they come under the category of non-current, or vice versa. They are under the category of non-current, but they are shown as current. We need to take this into account and reclassify them and apply IFRS in measuring all recognized assets and liabilities. We'll apply the guidelines of IFRS standards to recognize these values. The general requirement of IFRS is full retrospective application of all accounting standards effective at entity's reporting date, but this is not possible. All the countries and accounting bodies will object to it. Is the reason there is a facility provided in the form of IFRS 1. Two types of exemptions given. One is mandatory exemptions and one is optional exemptions. Actually, these two words are IFRS 1 first time adoption of IFRS. If you understand these two words and if you understand what are the guidelines, what is the facility provided, we can easily convert the previous year balance sheet into a new formatted balance sheet, because most of the figures we simply need to carry forward. So these are mandatory exemptions. Hedge accounting, if you notice, hedge accounting is for protecting the risk exposure. Once it is settled and once it is over, there is no point going back, getting into that transaction, because there is no value added. So this is mandatorily exempted. Estimates are mandatorily exempted, because if we apply a retrospective effect to estimates, we'll go against the accounting mentioned in IAS 8 accounting policies, changes in accounting estimates and errors, which says that if there's any change in accounting estimates, we'll have to apply the effect prospectively. So there's no chance of applying the effect retrospectively in case of estimates, because even IAS 8 wants us to do so. So this also comes under the purview of mandatory exemptions. Though even if they wouldn't have mentioned it, we wouldn't have estimated our estimates retrospectively, because IAS 8 also permits us to apply the effect prospectively. But in this case, there are some areas, like in India, we were having change in depreciation method was a change in accounting policy, but under IFRS, change in depreciation method is considered as a change in accounting estimates. So some of the items may also give us relief for not going backwards. Non-controlling interest, NCS valuation, even if you go back and calculate it, will have no meaning, will add no value to us. And the criteria may have changed, the amounts may have changed, the business combination may have changed. For any financial instruments which have already been de-recognized or assets or liabilities, there will be no point applying the retrospective effect to them and presenting them again and bringing them back onto the balance sheet when they are settled. So these are the 4 areas which are mandatorily exempted, because they may not be existing in the balance sheet, or they may be settled by the end of the period. De-recognition of financial assets and financial liabilities. The first time adopter de-recognized non-derivative financial assets or liabilities in accordance with its previous gap as a result of a transaction that occurred before 1st January 2004. It shall not recognize those assets and liabilities in accordance with IFRS. This is a mandatory exemption given. Hedge accounting is to be used in the period in which IAS 39 is first adopted. Now it is IFRS 9 when it is first adopted, because there is a change in hedge accounting methods. There's a slight change in the 80-125 relationship, which we discussed when we were discussing IFRS 9 financial instruments. IFRS 1 allows following information in respect of minority. Minority is known as non-controlling interest to be disclosed prospectively. We do not need to go back to correct it. Attribution. So whatever is the appropriation of profit of our consolidated financial statements, so we can attribute it. We are required to attribute it among parent and NCS. We can do it prospectively. We do not need to go back to recalculate what happened in the past. An entity's estimates in accordance with IFRS at the date of transition to IFRS shall be consistent with estimates for the same date in accordance with the previous GAAP. So we may need to modify some of the estimates if they are not in line with the definition of estimates under IFRS. So estimates, if they are required by previous GAAP, we'll make those estimates reflecting conditions at the relevant date. We'll adjust them. If there is any evidence of error, we'll correct it. Is calculation consistent with IFRS? If yes, we can use the same previous estimate and carry it forward. We may not revise it, but if it is different from the objective of estimates as per IAS 8 accounting policy changes in accounting estimates and errors, we need to revise this estimate prospectively, not retrospectively. Use previous estimate and adjust to IFRS, apply the effect prospectively. These are optional exemptions for business combinations, share-based payments, insurance contracts, leases, employee benefits, fair value, or revaluation as deemed cost. So there is a choice given. Now in India, property, plant and equipment is carried forward as deemed cost. Under IFRS 1, they give a choice whether fair value or revaluation or as deemed cost. They can use them also as deemed cost if the previous GAAP is using revaluation model. Compound financial instruments, designation of previously recognized financial statements, the cumulative translation differences. Like cumulative translation differences are unrealized gains or losses, which you show as foreign currency translation reserve. So IFRS gives a choice that you can reset them to zero. Borrowing cost, fair value measurement, initial recognition, you can carry forward. So there is a way out given in each segment, assets and liabilities of subsidiaries, JVs, and associates. So there is an optional exemption. We don't need to apply the effect retrospectively. So there is a way out given in each of the category. So for business combinations, a first-time adopter may elect not to apply IFRS 3 retrospectively to past business combinations, which shall have following consequences. So same as previous GAAP, recognize all assets and liabilities acquired in combination in accordance with IFRS except not recognized by IFRS. So according to IFRS 3 business combinations, we need to revise them. We'll apply the effect prospectively, but we may not go back as far as it is practicable to do so, or apply the effect retrospectively, as if we have been using IFRS since beginning. Recognize assets and liabilities which are not recognized in business combination by the acquirer, but now recognized. So if there is any assets and liabilities which are not recognized earlier, simply because we were using business combinations of the previous GAAP, now when IFRS 3 becomes applicable, we'll have to follow the guidelines of IFRS 3 business combination. So there is a relaxation in terms of applying the effect retrospectively, but there's no relaxation in terms of not applying the standard applicable in IFRS. So we have to follow the guidelines of the IFRS standards. So there's an exemption from applying the effect retrospectively. However, if it restates any business combination to comply with IFRS 3, it has to restate all later business combinations. So if it does so, then they'll have to do so even in future. Fair value or revaluation model as deemed cost. Entity may elect to measure an item to measure following at the date of transition to IFRS at its fair value and use that fair value as its deemed cost. Property, plant and equipment, IAS 40, if an entity elects to use the cost model, or intangible assets that meet recognition criteria, revaluation criteria in IAS 38. Subsequently, depreciation is based on this deemed cost and starts from the date entity established a fair value measurement or revaluation. So whatever is the value according to the IAS 16 property, plant and equipment, or IAS 40 investment property on, or IAS 38 intangible assets on this date. So that cost which has been recorded in the previous GAAP can be considered as deemed cost and carried forward. Or the new fair value or revaluation on that particular day can be considered as deemed cost. We do not need to recalculate it going backwards using the principles of IAS 16, 38 or 40. In India, we can consider even the cost as deemed cost. Investments in subsidiaries, joint controlled entities and associates. Now it becomes very difficult if you apply the retrospective effect to all. So first time adopter has an option to measure investment in subsidiary, joint controlled entity and associate at one of the following amounts: cost determined as per IFRS 10 or deemed cost of investment, which will be fair value on the date of transition and previous GAAP carrying amount at that date. So it can be either of the two, either cost as per IFRS 10 financial statement criteria or deemed cost of investment, which can be fair value, which can be the previous GAAP cost. So this is a huge relaxation. Assets and liabilities in subsidiaries, joint controlled entities and associates. If a subsidiary becomes, now this is important, if a subsidiary becomes a first-time adopter later than its parent, then if a parent adopts, then also we need to measure all its assets liabilities, carrying amount of parents' consolidated financial statements based on parents' date of transition, or carrying amount required by IFRS. If a subsidiary is not under the purview of IFRS, but if parent is under the purview of IFRS, even the subsidiary for the purpose of consolidation will have to prepare IFRS compliant financial statements, because otherwise how they'll be able to facilitate the parent, whether they like it or not. Since parent has to present consolidated financial statements on the basis of IFRS, they will demand it from the subsidiary. Subsidiary will have to present reports in terms of IFRS to the parent to be able to facilitate presentation of consolidated financial statements. No choice to them as well. But they can measure them according to the principles. They can use the carrying amounts as required by IFRS based on entities, date of transition, or carrying amount in parents' consolidated financial statements. So they can use the same figures which the parent believes according to IFRS, or they can calculate on their own. If a parent adopts IFRS later than its subsidiary, it shall measure assets and liabilities of subsidiary at the same carrying amounts as in the financial statements of subsidiary. Since subsidiary has already adopted it and parent is required to adopt it later, they can use the same figures because they are IFRS compliant. Share-based payment transactions. The first-time adopter is encouraged but not required to apply IFRS 2 share-based payments to equity instruments. However, if a first-time adopter elects to apply IFRS to such equity instruments, it may do so only if the entity has disclosed publicly the fair value of those equity instruments determined at the measurement date. If the fair value is not publicly available, they may not apply to equity instrument. Insurance contracts. There's a new standard. This is in a dilemma now. IFRS insurance contracts. So what happened in India? We decided that first you want us to apply IFRS 4, and now you want us to move to IFRS 17. We'll not get into this trouble because there is a compliance cost of moving on to IFRS now if we implement IFRS 4 insurance contracts. And to us, majority of our transactions are related to this standard. And in 2021 or 2022, earlier the date was 2021. Now it is postponed to 2022. Yet a final date. So it is in a dilemma. It is in the new date for application of IFRS 17 insurance contracts is not yet released. There is a proposal that the date was 1st January 2021. There is a proposal to postpone it to 2022. Still not final because they're still in progress. So IRDA in India decided that no, will not be moving to IFRS. They have postponed it for indefinite period until IFRS 17 gets introduced. They will not be implementing IFRS. So banks and insurance industry are the ones which has not implemented IFRS as of date in India, because they're waiting for. And they were also there was another concern, like why they did not implement it in the previous phases when all other entities were implementing. IFRS 9 financial instruments was going to be introduced from 1st January 2018. The majority of their transactions were being hit by these two standards, IFRS 9 and IFRS 17. And if they implemented earlier, there is an unnecessary compliance cost. So IRDA ruled it out, but they still demanded one-pager information on the basis of Ind AS. IRDA still demanded information on Ind AS, but it was not implemented in those. It was just a disclosure requirement. So first-time adopter may apply the transitional provisions in IFRS 4 insurance contracts. IFRS 4 restricts change in accounting policies for insurance contracts, including change made by first-time adopters. Since there were irregularities around the world, all the insurance companies were using it according to their own convenience because they believed that they are preparing fairer presentation than as guided by IFRS 4. So IFRS 4 was not complete in all respects. They were simply guiding that we can use financial instruments criteria for recording, or simply guiding, but it was not clear in its approach to determine how insurance companies are going to implement IFRS 4 construction insurance contracts. So still there are a lot of doubts even after introduction of IFRS 17 insurance contracts. Lease is a first-time adopter may determine whether an arrangement exists at the date of transition, contains a lease on the basis of facts and circumstances. If a lease exists, an operating lease may now be considered as a finance lease. A finance lease may now be considered as an operating lease. In future, 1st January 2019, IFRS 16 got introduced or implemented. In India, it got implemented for the financial year beginning 1st April 2019. Now, if they had implemented it earlier, had made any changes, this new introduction of standard will be coming in with transitional provisions. So this is different from IFRS 1. IFRS 1 is used once. Now, in future, if there is any change in accounting policy, this comes in with the transitional provisions, that how that implementation will happen, of that particular standard, which is introduced new to all the entities or for the preparation of financial statements, how this new standard will be implemented now. So there are guidelines in terms of transitional provisions whenever they issue a new standard. Employee benefits as per IAS 19 entity may elect to use a corridor approach that leaves some actual gains and losses unrecognized. However, a first-time adopter may elect to recognize all cumulative actual gains and losses at the date of transition to IFRS. So there is a choice given. You can continue to use the existing approach or the unrecognized actual gains and losses approach as given by IAS 19 employee benefits. Compound financial instruments. Now this results in recording or bifurcating the financial instruments into two components, equity and liability. The previous GAAP may not be using it. So IAS 32 requires an entity to split a compound financial instrument at inception into separate liability and equity. Per IFRS 1, a first-time adopter need not separate these two portions if the liability component is no longer outstanding. So if the liability component is no longer outstanding, the only component left is equity, which can be shown as part of equity after it is being implemented. Designation of previously recognized financial instruments. A first-time adopter is permitted at the date of transition to IFRS to make an available for sale designation any financial asset or financial liability as at fair value through profit and loss, provided it meets IAS 39 criteria. Now I should make it IFRS 9 criteria because IAS 39 is no more applicable. So they can designate it as available for sale is permitted at the date of transition. Available for sale means they'll be measured at fair value through P&L. Any financial asset or financial liability as at fair value through P&L, provided it meets IFRS 9 criteria. So earlier they may not be using these criteria, but on first time adoption they can do so. Borrowing cost, a first time adopter may apply the transitional provisions set out in paragraph 27, 28 of IAS 23 as revised in 2007 may apply. So there is an optional exemption to apply the respective effect. Cumulative translation differences. This is the most interesting one. The cumulative translation differences for all foreign operations are deemed to be zero. We can reset them to zero instead of recalculating it. The gain or loss on subsequent disclosure of any foreign operation shall exclude translation differences that arose before the date of transition to IFRS and shall include later translation differences only in terms of profit and loss. So we can reset them to zero because they are all unrealized gains and losses. They are not the performance measure for managing the performance of the management. They are simply because we translated from the functional currency to presentation currency, it resulted in some gain or loss which is presented as foreign currency translation reserve as part of OCI. Now we are introducing OCI for the first time. If the previous GAAP has something in terms of foreign currency translation reserve, we can reset them to zero and give a fresh life to it. Decommissioning liability is included in cost of property, plant and equipment. If you remember, there is a cost of dismantling or decommissioning, which is added as part of the cost of the asset. So change in liability is added or deducted from the carrying amount of the related asset, subject to not creating a negative asset, because asset cannot go down below zero. Either asset exists or either it doesn't exist. It cannot be a negative asset, and the result is depreciated over the asset's remaining useful life. Hope it makes sense that asset cannot be negative in the financial statements. It can be nil, it can be ruled out of the financial statements. Either it is giving us benefit or either it is out, derecognized. Simply because of the change in accounting if it results. Now we'll disclose the comparative information. Interim reporting also presented on basis of IFRS, the first year interim, first half, or even if it is quarterly, is to be presented on the basis of IFRS. Other disclosure requirement, any material adjustments. So what we do, we derecognize not as per IFRS, we recognize as per IFRS. This is bound to result in some adjustment, some increase in assets, some increase in liabilities. We make those adjustments. After these adjustments, we have IFRS balances. Some plus on the assets, some minus on the assets, some plus on the liabilities, some minus on the liabilities. The net impact is adjusted against retained earnings, and the new balance becomes the new IFRS balance after we make all the adjustments of plus and minus in the retained earnings. Explanation of transition impact on financial position, performance, and cash flow is also provided as part of notes to accounts on first time adoption. Reconciliation of equity at transition date and end of the latest period presented under previous GAAP. What is the position of equity? So we present it by presenting the third balance sheet of 1st April. We present the position of equity and position of balance sheet on conversion and reconciliation.